how to calculate your RMDs or required minimum distributions and build a bond ladder for your RMDs. Hello, members, super savers, and bond course fans. I hope you're healthy and well. So, RMDs or required minimum distributions, the minimum amount you have to take out of certain types of retirement accounts from a certain age. This is a topic that many in our Diamond NestEgg community have been asking for quite some time now. So, thank you to everyone who has so patiently waited for this video. Here are the 3 topics that we'll be covering in today's video. 1. How can you calculate your RMDs easily, regardless of whether you're years away from taking them, about to take them, or are already taking them? 2. How might you build a bond ladder to meet your RMDs? And 3. What are some important factors you need to consider? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. As I just mentioned, RMDs, or required minimum distributions, are in essence defined minimum amounts that you must withdraw from certain types of retirement accounts from a certain age. Specifically, RMD rules apply to tax-deferred retirement accounts. So, any retirement account that you saved for with pre-tax money that hasn't been taxed yet, such as traditional IRAs, rollover IRAs, simple IRAs, SEP IRAs, inherited Roth IRAs, as well as most 401k and 403b plans, including self-employed 401k plans. And the reason for this is because the government wants to collect taxes on your tax-deferred earnings at some point. So, while with the right retirement account, you can avoid taxes while building your nest egg, the taxman will remember, and you will have to pay taxes eventually when you start withdrawing that money in retirement. And that is the ultimate purpose of the RMD rules, to make sure that you actually start withdrawing that money and paying taxes on it at some point. Which also means that for Roth IRAs, there are no RMDs because you've already paid the taxes on that money when it went into your Roth. The only exception is when you inherit a Roth IRA from someone else and haven't really paid the taxes on it yourself. If you hold one or more of these retirement accounts that are subject to RMDs, here's when you will have to take your first distribution, if you're not doing so already. If you were born on or after January 1st, 1951, but before January 1st, 1960, you will have to take your first RMD in the year when you turn 73. If you were born on or after January 1st, 1960, you will have to start taking RMDs in the year when you turn 75. The amount of your RMD for every year is calculated by dividing the value of your retirement account. So one of these ones shown here by a life expectancy factor that is set by the IRS. And note that the IRS calls this life expectancy factor a distribution period, but it's really the same thing. There's several different life expectancy tables, but this one here seems to be the most commonly used one. And it's specifically for IRA and 401k account owners who are unmarried, married with spouses who aren't more than 10 years younger, or married with spouses who aren't the sole beneficiaries to that account. I've linked this table in the first pinned comment below this video for your convenience. So let me walk you through how to use this table. And because quite a few of you have told us that you like real-life examples from our community, we're actually going to use a real-life example for this walkthrough, a Diamond NestEgg member who we'll call Sally. Let's pretend that Sally turns 73 this year, in 2024, meaning this is the first year she will have to take an RMD. So from this IRS table here, we would look for age 73 and the corresponding distribution period, the life expectancy factor, which in this example is this 26.5 here. Remember that number. To calculate Sally's RMD at her current age of 73, here's what we would do next. We would take the value of Sally's IRA at the end of last year and divide that amount by the corresponding distribution period from the IRS table for age 73. This 26.5 number here from before. Sally told us that the value of her IRA at the end of last year was $800,000. Divide that by 26.5, and this resulting number here of $30,189 is Sally's RMD at age 73. So the minimum amount Sally has to withdraw from her retirement account this year is $30,189. Simple enough, I would say. Now, we and Sally know how to calculate our RMDs for every year of our retirement. But a few more comments on RMDs. Sally can always take out more than her required minimum distribution if she wishes to do so, but she cannot take out less. Normally, the deadline for taking your RMD is December 31st of each year. But because in this example, Sally just turned 73 this year in 2024, and this is her first RMD, she can delay taking her actual distribution until April 1st of next year. So April 1st, 2025. And to repeat, this exception is only for the very first year in which the RMD rules apply. If Sally does decide to push out her first RMD, the 2024 RMD, to 2025 though, in 2025, she will have to take both her first RMD, the 2024 RMD, as well as her 2025 RMD. So both RMDs in 2025 together. Now, because withdrawals from tax-deferred retirement accounts, including RMD amounts, are generally taxed as ordinary income in the year in which they're taken and subject to progressive taxation like any ordinary income, taking both her 2024 and 2025 RMDs in 2025 together might potentially push Sally into a higher tax bracket. And to complicate things further, because why make them easy, right? If Sally misses her RMD deadline, if she fails to withdraw the full amount of her RMD by the due dates we just talked about, the amount not withdrawn is subject to a 25% penalty tax. So basically, don't miss your RMD deadline. But here's the thing. There's almost always a catch, right? So, in real life, Sally didn't turn 73 this year. She's actually only 63 as we tape this video. So, how can she estimate what her RMDs will be in absolute dollars during her future retirement? So that she can plan for it and buy some bonds now while rates are still attractive to ensure that her future RMDs are covered to some extent, meaning she will ideally have the cash available to cover her RMDs without having to sell other parts of her portfolio when she doesn't feel like it. For example, if she experiences a market downturn and her equity investments are all down. Well, that's not a trivial question. While we can make the assumption that this table with the minimum distribution periods may not change during her retirement, what is a bit harder to predict is what value Sally's retirement savings may have in the future. Remember, the actual amount of the required minimum distribution in dollars in any given year is determined by the value of the investments at the end of the preceding year, divided by the applicable distribution period. So the basis for the RMD calculation changes every year. Well, luckily for Sally and for all of us, my fixed income friend, we found all of you an RMD calculator from Fidelity that can help you with planning for the future. And you don't have to be a Fidelity customer to use it. I've linked it below for your convenience. So going back to Fidelity's RMD calculator, here we'll enter Sally's date of birth as January 1st, 1961. And I'll click yes here because Sally is married. And this section will pop up asking for her spouse's date of birth. Let's put in January 1st, 1962. You should know that we actually only know Sally and her spouse's year of birth because we've tested this RMD calculator out a bit, and the year of birth is what's most relevant in these date of birth fields. Changing the month and day of birth generally do not have an impact on the final RMD calculation. Now, let's scroll down and put in Sally's IRA balance at the end of last year, which, as we mentioned earlier, was $800,000. And here we can put in Sally's estimated rate of return on an annual basis. This number is basically used to calculate how much Sally's portfolio will grow from now and through her retirement. 5.5% is the default rate used in Fidelity's calculator, and we think it's a solid general assumption for a portfolio that has a more or less balanced mix of equities, fixed income, and potentially other assets. Of course, when Sally does this herself, Or when you do it yourself, you should change this number to whatever suits your situation. But per the note here, if you're not sure what better rate you would use for your situation, consider using the default rate shown here, this 5.5%. Now, let's click on See Your Estimated RMD. And this screen appears next, showing us that Sally's estimated 2036 RMD is $61,827.89. 2036 is the year that Sally will have to take her first RMD. And on this side, there's some important information on Sally's first RMD. The deadlines here, the penalty for missing those deadlines here, and the taxation of RMDs as ordinary income here, all of which we've already talked about earlier. And if we scroll down further, we can see that this calculator has projected out Sally's RMDs not just for 2036, the first year that she has to take an RMD, but for the next 4 years after that as well. And these projections are what we will be taking along with us to the next section of this video. Let's go back to these RMD projections for Sally from Fidelity's calculator. The simplest way for Sally to build a bond ladder is to buy bonds that will mature in these years, with principal repayments at maturity that are equal to or close to what these estimated RMD amounts are for any given year. Here's an example of what Sally's RMD bond ladder could look like. Assuming that this year is our starting year, Sally could purchase approximately $62,000 in par value of a 12-year treasury to cover her first RMD in 2036. Either just normal treasury bonds or perhaps even some TIPS, treasury inflation protected securities. She could then purchase $65,000 in par value of a 13-year treasury to cover her second RMD in 2037. $68,000 in par value of a 14-year treasury to cover her third RMD in 2038. $72,000 in par value of a 15-year treasury to cover her fourth RMD in 2039. And $76,000 in par value of a 16-year treasury to cover her fifth RMD in 2040. All the treasuries in this bond ladder example would need to be purchased on the secondary market, as they are not maturities that the treasury issues at auction. Bond masters, folks, please refer to Module 3 for a refresher on bond laddering and other bond strategies. And while this illustration shows a bond ladder with primarily treasuries, if Sally were so inclined, she could also add some agencies and or corporates to the mix for a bit of a higher yield. Building an RMD ladder like this means that Sally can count on a predictable cash flow and may not have to worry about having to sell investments that she doesn't want to sell in any given year to cover her RMDs. For example, if the market hits a bad patch at that time and all her equities are down in value. So, if between now and when Sally has to start taking her RMDs, the actual average annual return on her portfolio is exactly 5.5%, this default rate that was used to get to these estimated RMD amounts and build out this bond ladder example, then Sally would have just about the right amount of principal repayments from her maturing bonds every year to cover her estimated RMDs. However, if the actual average annual return on her portfolio is less than this 5.5%, meaning that her investments perform worse than she had expected, she will have more principal repayments from her maturing bonds than she needs to cover the smaller RMD amounts on her diminished portfolio in some years. But she may be relieved that she does not have to sell her underperforming investments at the wrong moment at a loss to cover the RMDs, as she may have had to do without such a bond ladder. And remember, that is one of our goals here, to give Sally enough coverage from her bond ladder so that she won't have to sell investments that she doesn't want to sell in a down market. Plus, if it turns out that Sally really doesn't need all of the principal repayments from her maturing bonds to cover her RMDs and other expenses, she would have the option to reinvest those proceeds elsewhere. And as this may happen in a down market, there might even be some attractive opportunities to be found. Finally, in the best case scenario, if the actual average annual return on Sally's portfolio is more than this 5.5%, well, That means that her investments have performed better than she had expected, which is great, but in this instance, the principal repayments from her maturing bonds will not be enough to cover the actual required withdrawal amounts in full in some years, as the RMDs increase when an investor's portfolio increases, as we covered earlier. Meaning that Sally may have to sell some of her other investments to bridge the RMD gap in these up years. But in my mind, that's not exactly a bad position to be in. And also, having more money than you were expecting is not exactly a bad reason to have to pay more than these estimated RMD amounts here. Because if Sally has to sell some equities, let's say that are worth a bit more than she expected, then she should still make a tidy extra gain even after taxes, because she won't be selling at a low point either. In a nutshell, building an RMD bond ladder like in this example gives Sally, or any other investor for that matter, the peace of mind that he or she has at least some, if not all RMDs covered when the RMD deadline hits, so that the investor is not forced to sell investments that he or she does not want to sell at that point in time. Now, do keep in mind that all calculators are based on a certain set of assumptions, and this RMD calculator is no different. One of these assumptions we've already talked about at length, this 5.5% estimated annual rate of return. If we click here, this will bring up an even more detailed list of calculator assumptions. You can read through these assumptions here, but I've also included the link to this page in the first pinned comment below so that you have all the information you need on hand. So, now that you know how to calculate your actual and/or estimated RMDs, and how you could start building an RMD bond ladder, let's move on to the next section of this video. So in addition to what we've just discussed, here are 5 important points about RMDs and RMD bond ladders to consider. Always remember, 1. If you're still working when you're required to take your RMD, you may qualify for an exception from taking RMDs from your current 401k, 403b, or other employer-sponsored retirement account until April 1st of the year after you retire. You would, however, still have to take RMDs from all of these accounts here, as well as any other former employer-sponsored retirement accounts of which you're no longer an active participant. 2. You have to calculate the RMDs separately for each IRA that you own, but you can withdraw the total amount from one or more of the IRAs. 3. Similarly, you have to calculate the RMDs separately for each 403b account that you own, but you can take the total amount from one or more of your 403b accounts. 4. For other types of retirement plans, such as 401ks and 457bs, you have to calculate the RMDs separately for each of those accounts, and you must also take RMDs separately from each of those respective accounts. And 5. RMD rules can and do change over time, as we've already seen over the past few years. If we take Sally as an example again, her first RMD is in 2036. That's more than a decade away. Who knows what new RMD legislation there will be by then? So, while I think it's a good idea to get a sense of what your RMDs might look like in the future, and to potentially build out an RMD bond ladder like this if it works for you, especially with rates where they are currently, my general recommendation would be to review your financial situation regularly to make sure that whatever estimated RMD amounts come out of this calculator and whatever RMD bond ladder you might have continues to make sense on an ongoing basis based on your individual circumstances, goals, and expectations, and what the latest RMD rules are. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And if you want to really get up to speed on bond investing, bond laddering, and building out your bond portfolio while rates are still attractive, then check out this video here on a 2024 bond courses. Or come join our next live sessions. Our next live bond beginners course session will be on Friday, October 18th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be talking about the 20-year T-bond and 5-year TIPS auctions. And our next live YouTube member Q&A will be on Sunday, October 27th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be discussing the 2, 5, and 7-year T-note auctions. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.